And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of the Real Investment Show, third best day of the week, as we've been talking about all week long.
You've got a thing for that, don't you?
I know, we do. We started a whole new trend here. Best days of the week, counting down backwards. Couple of things to get into today as we kind of really continue to kind of work through this month and really kind of as we still struggle through with this contested election, et cetera, what the outcome's going to be. There's a lot of things that are going on. The markets are trying to make a lot of shifts here based on expectations and outlooks. Of course, over the last couple of days, we saw a very sharp rally in these kind of beaten up value sectors, right? We've talked for a long time now about value versus momentum, and this has been very much a momentum-driven market up to this point. But over the last couple of days, big switch into value when we've seen financials and energy, some of these beaten up companies, really starting to perform better here. This is an interesting paradox, so to speak, because you're talking about value companies, but in a lot of these cases, these companies that appear to be relative value companies actually are highly leveraged companies. We've talked about the problem with what's called a zombie company. And these are companies that depend upon more debt issuance in order to sustain their operations. And we have the largest number of zombie companies in the markets today than we've had at pretty much any point in history. And part of this is due to the fact of what the Federal Reserve has been doing. Right, intervening into corporate bond markets, intervening into high yield markets. Yes, the message is that we have to do this, and to a point that was true because when you take a look at what really drives the economy overall, it's really not the stock market, it's the credit markets, and it's the ability of companies to go to the market, obtain credit, borrow money for operational reasons, for expansions, acquisitions, whatever they want to use it for. Of course, a lot of that's been for stock buybacks and for dividend payments, which are non-productive, but that's really the important thing. I mean, think about all the things in the economy that revolve around debt, right? You want to go spend money you don't have, credit card debt. You want to buy a house, mortgage debt. You want to buy a car, auto loan debt. Yes, sure, you could pay cash. Most people don't have that kind of cash saved up to go pay cash for a car or cash for a house, but it is doable. But when you take a look at the global really kind of economy, it really relies on debt. Today, in our economy, we're currently running about $75 trillion worth of debt. That includes student loan debt, credit card debt, auto debt, corporate debt, government debt, all the debt together, $75 trillion in a $19 trillion economy. So you think about that, it's taking roughly about $5 of debt to generate $1 worth of economic growth, which means that if interest rates rise much, kind of the whole house of cards comes down pretty quickly, which is why interest rates remain suppressed. Why am I telling you all this? Well, a lot of expectations over the last couple of days, and when we take a look at the S&P, a lot of this rally was an expectation that, we're going to get back into kind of the swing of things. We're going to get more stimulus, which is, by the way, run by debt. The Federal Reserve is going to take that stimulus, and they're going to do more QE to markets, and we're going to continue to grow this economy, right? We're going to come out of the recovery, out of this recession, get back into recovery. Here's the problem with the entire narrative. Too much debt. And as we kind of go back to this issue, there's no focus right now on debt and what goes on with debt, but importantly, it is the impact of debt that slows economic growth. So yes, we are seeing a recovery. If you take a look at inflation, right, there's been a lot of talk here about inflationary pickups, and this is why we've seen some of these areas of the market starting to recover. We're seeing an inflation pickup. True, we're getting back to where we were previously in terms of inflation, which was already a low rate of inflation to begin with. Interest rates are picking back up. Yes, after collapsing earlier this year, they are rising back up to a more what will be a new normalized level for interest rates on bonds, at least in the near term. So rates back up to around 1%, but if they get much above that, That's going to be problematic for things like mortgage rates. In fact, 30-year mortgage rate is starting to already come up. As soon as rates rise, people wanting to buy houses, apply for mortgages, etc., they're going to pull back and say, hey, I'm going to wait for those rates to come back down again, right? Or mortgage payment's too high, I can't afford it. So there's such a tight correlation between what happens in the economy and what ultimately happens in markets that we've got to pay attention to this. Yes, we are getting a recovery in the economy. The stock market is extremely far ahead of that recovery and what that recovery is ultimately going to mean. So as we take a look at where we should be investing and what areas we should be chasing, we have to think about this. And while we're talking about an economic recovery, and yes, over the last couple of days in particular, we've seen this kind of rotation into value, my suspicion is that rotation into value will be fairly short-lived. Because ultimately, as we get down into looking at where earnings are going to grow from, it's going to be more problematic in an economy that's growing somewhere between 1.5% and 1.75% for a lot of these companies to generate revenue growth, as compared to some of the other companies in the markets, which have been more of your primary momentum-driven stocks to begin with, to generate revenue growth in terms of their earnings. And, technology, productivity, artificial intelligence, cloud storage, these type of things, they're going to continue to generate higher rates of growth in terms of earnings than other of your more traditional economic plays because of the switch in the economy to deriving more productivity from every individual they employ. Now let's talk about one other thing here that's very interesting. If you take a look at the quit rate, now these are the number of people that are quitting their jobs currently. We're already back to where we were pre-pandemic for people quitting their jobs. People being laid off has now hit a new low. Now, what does that mean? Well, it means that people are now confident that they can quit their job and go get another job fairly quickly, and the number of people getting laid off, well, that's dropped to a point to where we're not laying off any more people. In other words, we've already laid off as many people as we can. I mean, in any environment, a company has to maintain some level of employment just to stay in operations. So when you lay off virtually all your staff, you still got to maintain a few people to run the company. So we were getting to the point where we've laid off most of the people that we're going to lay off. What this suggests is that we have now or will technically establish a new level of employment as we go forward. In other words, it'll be more people sitting outside of the labor force. Your labor force participation rate will lock in at a new low as we kind of go forward, which will be a lower level than we saw after the financial crisis. The number of people actually working in the economy will be fewer. And wage growth is going to start to moderate as we begin to start to look at replacing more people with technology, productivity, storage, these type of things. This is going to be kind of the new dynamic, the new normal. We talked about the new normal following the financial crisis. Well, now we're talking about the new normal again following the pandemic. So these are all the things to consider here when you start looking at where to allocate money. This was an email question I got this morning, which is, well, in this market, where do you allocate money, right? You've got to be careful with this because, again, as we develop this over the course of the next few months, as we get through this year and into 2021, start looking at the new landscape for the economy, where growth is going to be coming from, where expectations are going to be coming from, and what guidance are going to be from companies, I would suspect that this very short-lived value rotation will be just that, and we're going to see money starting to move back into areas that have the ability to generate higher rates of earnings growth as we go forward into 2021. So we've got some more coming up on this here soon, but pay attention to it, and we'll be writing about this on our blog site as well as our newsletter at our website, realinvestmentadvice.com. Stick around, though. Danny Ratliff coming up. Lots of stuff to get into this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election. Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. I'm your host, Lance Roberts. Danny Ratliff joining me this morning, CFP. A few things to talk about. Good morning. How are you?
I'm doing great. You?
Awesome. It's Wednesday.
Is it? I can't even tell what day it is anymore.
It's the third best day of the week.
Third best day of the week.
Exactly.
Perfect.
We're going by best days of the week now. We're optimistic here on the show.
Days that end in Y.
No, that's every day.
Exactly. Every day's good, man.
Every day's good.
Happy to be alive.
Anyway, so a few things that are going on, of course, as I was just talking about a second ago. We've got this value rotation that seemed to pick up here over the last couple of days. And again, lots of talk about that here recently. And again, there was just a big disparity between a lot of these momentum stocks and these value stocks. So you're seeing this rotation. The ability for it to stick is somewhat suspect. And that's really my point that I was making a second ago, because ultimately, as we look at where the economy is going to be over the next, year, this is going to be more of a challenge for companies to generate earnings growth as well as to generate revenue growth. And that's a lot of these value-based companies are in that problem, that they are in part of the economy that is going to be the most impacted by a lower employment rate, and what I mean by a lower employment rate is not a lower unemployment rate. We're going to get back to full employment by next year. But full employment next year will look very different than what full employment was in 2019, because we'll have a lower number of people participating in the labor force. We'll have a wider dispersion of people in the labor force in terms of where they're actually working and producing and generating a living. And this is going to lead to more of that wealth gap. And this is kind of an interesting point, right? Because we're talking about wanting to do more stimulus. We need more stimulus. The Federal Reserve even, hey, we need more stimulus for the economy. Well, the problem is that, we're saying, hey, we need more stimulus, but, this is the problem with wanting to do these broad stimulus packages, right? Let's just shoot a whole bunch of money out of a cannon and let's see what sticks. Well, the problem is we saw with the PPP programs is there was a lot of fraud in the PPP programs. People were just forming corporations putting to go get PPP loans. I mean, I didn't think about it, but that's genius, right? I've got a business. I need a PPP loan. Well, here's some money, right? Because they were just giving it out. And so the problem is, if we're going to do stimulus, do we need stimulus? And the answer is probably yes, but it needs to be very, very targeted to what you're actually trying to solve, and then have a process in place to make sure that you can minimize the fraud's going to occur. Whenever you're throwing money out a window, you're going to get fraud. Right? This is why we have, we probably lose $100 billion a year in Medicare and Medicaid fraud, right? Every year. Social Security fraud. If we could eliminate a lot of the fraud that goes on in these social programs, we could probably extend the life of these programs by a couple of decades, right? So, but this is the problem with any time that you are involved in these programs. People are smart. People are going to figure out a way to defraud the system and to take advantage of it. So, that's going to be one of the issues that are going forward. But so do we need stimulus? Probably, right? The question is where do we need it? If we have people back to employment and working and doing those type of things, do we need to be giving them stimulus, right? So this is going to be the question, because the more stimulus that we rack up, that's the more debt we pick up, and that also retards the economic growth rate, which makes it even more difficult longer term to get people who are out of the workforce back into it. So, there's a dark side to, while stimulus sounds like a good thing, and it's a short-term Band-Aid, it has a long-term negative effect, because when you do stimulus, you drag forward future consumption, which leaves a hole in the future that you've got to fill with more stimulus, and now you're in the trap, because at some point you got to say, hey, can't do stimulus, and you're just going to have to deal with that big slowdown in the economy when it occurs. And the longer that you defer that, the bigger that slowdown is going to be.
But will there be that when will they actually defer that? Because they continuously, we've seen
we don't
a decade of stimulus.
Right.
So they're not saying, well, okay, we're going to pull this back at this point and the economy is going to stand on its own two legs. Unfortunately, that's just likely not to happen anymore with the new policies that we see.
Right.
So when and how did they actually back away and take the punch bowl with them?
Well, there's two things. There's two ways this occurs, right? So you can do it by choice, but
nobody likes that one.
Well, nobody likes that one, but you can do it by choice, right? You can do a little. You can slow down the rate of stimulus. You can wean yourself off of it. The Federal Reserve can wean back on what they're doing. They can go ahead and raise interest rates very slowly. And for the Fed, the best option would be to raise rates slowly, right? Start hiking interest rates now, right? The economy's recovering. We've got lots of liquidity in the system. Start hiking rates here back towards what they call a normal level, right? Normalize your interest rate policy very slowly and telegraph this, right? Hey, we're going to raise interest rates a quarter point, and we're going to do 2 this year, and be very clear about it and stay to that plan, and keep the liquidity coming into the markets, right? That kind of buffers that impact of higher rates. Now you're going to get slower market returns, right? Markets are going to go down because of this, but that's okay, right? That's 10% of the economy that owns 90% of the stock market. They're the wealthy people, so let them deal with the stock market decline. If they're not smart enough to get out of the stock market, well, that's their problem. But let them deal with it. And then slowly start to normalize rates while you have all this liquidity in the system. Then once the economy normalizes to this new interest rates level, then you can start slowly extracting your liquidity and slowing that down. Now, you can do that by choice. Or at some point, the bond market's going to do it for you, and they'll do it all at once. And that's what you don't want, because that's the worst possible outcome.
Well, the other way is, essentially they're going to have to continuously pump money because we run debts and deficits like you talk about all the time. And where does that austerity measure ever come in?
It doesn't, until somebody does it for you. And
So
this
you're
is my
forced
point.
to.
Right, that's my point. You can, you can do things, right, in your life, right? You could eat a little better. You could, I have a good friend of ours on the show, and I've used him for years as a nutritional counselor, Keith Klein. Awesome guy. He has a very great saying that applies to this whole environment, which is make better bad choices, right? He says, look, you're going to make bad choices. You're going to go eat the hamburger, right? But try to make a better bad choice. Maybe instead of the hamburger with double cheese and double meat, how about a single patty with no cheese, right? Start making better bad choices. Wean yourself into making better decisions long term. Otherwise, you wind up with a heart attack. See, that's when it's forced upon you now to make those changes all at once, which is the hardest thing to do. And so we as a country, what we should do is start making better bad choices. Look, nobody wants to wean off of stimulus. Nobody wants to cut back on, the Federal Reserve interventions. Nobody wants to do these things. Nobody wants to balance the budget. Nobody wants to move back into basically running a surplus for the economy. But we can start making better bad choices about where we do stimulus, how we do these things, how much we supply, and start making these decisions. Oh, like, for instance, actually passing a budget would be a better bad choice for government.
I love that analogy, but when you're weaning yourself off, what type of impact is it going to have on the body? What's the nation going to go through if you actually go do something like this? That's the issue.
Well, just like when you go on a diet, right? It sucks at first, then you kind of get used to it, right? And then it's not so bad. So what are you going to go through? Well, the majority of Americans won't really be reflected in what happens in the stock market. Again, 10% of the population owns 90% of the stock market. So the stock market's not going to grow as much, right, until the stock market starts to get the idea that, hey, you know what, we're actually starting to see stronger rates of economic growth. Then the stock market will start to compensate. This big divergence between the stock market and the economy will start to correct. So, investments won't make a big return. SocGen, I've got an article coming out on Friday talking about why the Fed is stuck in forever stimulus. Societe Generale just did a great study, and they went back and analyzed small caps, mid caps, S&P 500, NASDAQ, and looked at the difference between the NASDAQ and S&P in these markets where they are today, where they would have been without QE, right? 57% of the return of the S&P came from stimulus. So if you subtract that out, the S&P wouldn't be currently trading where it is today. It'd be somewhere around probably 1,500-ish, which would be much more in line with an economic growth rate since 2009 of roughly 2%, 2.2%. So you would have a relationship between the market and the economy, which would make sense because the stock market, their earnings are what comes from economic activity. We've got this big divergence because of stimulus. People have been running into the stock market, chasing these stock markets, but this is why we've got valuations at 36 times earnings currently, when that valuation is not supported by the underlying growth rate of both earnings or the economy itself. So again, when you start to wean yourself off, these things are going to start to normalize and get back to where they are, to where you have real price discovery in the markets, and markets are more aligned with what's going on with economic activity, which is where they should be to begin with, to be better, to have a better investment outcome long term.
Which will be great for fundamental stock pickers, for people who can read balance sheets, for long term for the economy. But the economy's going to have the shakes for a very long time. Yeah. I feel like when you start to step back,
pretty much. But again, you can do it slowly, targeted, and you can do things to help try to support these issues and try to keep things, more normalized and stable. You could make these choices. We won't. Okay. And just by the way, if you're all shaking your head going, that'll never happen, you're right. It'll never happen, right? We'll never make these choices. We'll never make better bad choices. We will just continue to eat the double meat, double cheese until we ultimately get the heart attack. And then that's why we have seen and will continue to see these big crashes in the markets, 2000, 2008, March. We're going to continue to see these big booms and busts because of what we're doing. And these are like those warning signs of a heart attack, right? It's that, it's like indigestion, right?
Shortness of breath, yeah.
Yeah. Just a little indigestion, or no big deal. And then one day you wake up, or actually you don't. That's out of the point. Be right back after the break. I'm your host, Lance Roberts. Danny Ratliff joining me. Lots of stuff to get to. We're going to talk a little bit. What are we talking about coming up next, Danny?
What about taxes? Everybody wants to work remotely, but there's a lot of those unintended consequences people aren't taking into account. So we're going to talk a little bit about that.
Yeah, I want to know if I can deduct my home office now. Be right back on the break. Don't go away.
Look at you, now look at me. Look at you, now look at me. Look at you, now look at me. Now, look at you.
Listen anyplace, anytime at realinvestmentadvice.com.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Welcome back. I'm your host, Lance Roberts. Danny Ratliff joining me this morning, CFP. So, kind of interesting, right? We went into this whole, economic shutdown thing and quickly transitioned to this work at home type of environment. And what's interesting about this is that companies that have a lot of office space are now trying to sublease big chunks of their office space because they don't need it anymore, right? Well, the problem is when you're trying to sublease in this new environment, there's a lot of companies going, well, I don't want to lease space. All my employees work remotely. I don't need to sublease space. And so this is going to be a real problem for commercial real estate, potentially, if this continues to go forward. If we don't get back to normalcy. One thing we talked a little bit about yesterday was this idea that we will, get a vaccine, and whenever that vaccine would arrive, that people would go back to work, right? Maybe not, right? Maybe this is the new norm. What companies are figuring out is that, hey, this work remote thing is cheap, right?
you work at home, you pay your mortgage, you pay your electric bill, you pay your internet bill, right? I may give you a little subsidy for it, but that's a lot cheaper than renting an office space where I've got to pay, CAM and all the other stuff that goes on and provide you a desk and chairs and all that stuff. You buy all that and you just work at home, right? So much better idea. So all of a sudden, commercial real estate potentially faces a real problem. When going into this pandemic, Houston had about 6 million square feet of vacant office space that they were hoping to lease out. That didn't get leased. Probably won't get leased. So there's a lot of problem coming down the road for commercial real estate. Now, but there's another kind of interesting byline of this is that people are working at home. So the question is now is like, for instance, we have one home office in our house. Now we have two. So can we deduct both those home offices?
Well, it depends, right? So the Tax Cuts and Jobs Act of 2017 actually suspended the miscellaneous itemized deductions. So if you're an employee, you're no longer allowed to deduct that. So now those unreimbursed business expenses look a little bit different than what it used to.
Right.
So now if you're a partner in a firm, you can typically write these things off. So it's going to be dependent on your employees, your status. Mm-hmm. Do you work for a firm? Do you own one? Do you have a small business? Those are going to be where.
So what you're saying is the rich are going to get richer because the rich own the businesses and they get deductions nobody else does. Get it. I got it.
Well, yeah, the rich.
Let's tax them rich people.
Those bad people that employ other people. But you also have to have a dedicated home office.
Right.
So like you said, if you had one and now you have two, is it truly a dedicated home office? And the burden of proof is going to rely on you to explain this to the IRS should you be audited.
Yeah. I mean, ours are very defined offices, right? I mean, in our house. And it's interesting, too, because even home builders are getting onto this trend. It was either David Weekley or maybe Beazer, or Toll Brothers. I can't remember which one. It's one of the big major builders, but they are now offering floor plan options that include
genius.
A home office. So instead of having that dining room that nobody ever uses, they're now providing you the option to have a built-in home office and it's pretty cool, right? It's got a work shelf and work benches, the whole 9 yards. So kind of a neat idea, but I mean that's pretty much a dedicated space at that point for an office and makes it easy for IRS purposes. Hey, it was included in my floor plan.
It is here.
It is here.
I can tell you that is if I were to ever get divorced, that will be the reason. Because I love you, Michelle. But
you need an office?
No, she's like, when am I ever going to be able to get to use this office? And I'm like, that's why you have a laptop or an iPad or go somewhere else. You're on, then
go into the master closet.
But
that's
how
your
many,
office.
Yeah, how many of you guys can out there? Everybody can probably relate to this in some way, shape, or form. It's because, and I kid about the whole divorce thing. That won't happen. But
you should never even say that.
It's so funny because she's like, well, I can't even vacuum. I can't turn the music on. I can't talk on the phone because you're in video conferences or calls. And I'm like, I get it, but that's the way it goes.
Well, no, so in our house, so when we moved into our house, we have this, the house has a study, right? And so my wife, it has beautiful windows, got these floor to ceiling windows. It's got glass French doors. It's super nice. It actually has an iron door that leads to the wine room next to it, right? So she's completely set all day. Yeah, she's set all day.
Does she have her own bathroom?
As soon as no, she doesn't, but it's right there. The powder
that
room
would be set up. If I ever build a house,
the powder room is right around the corner. I mean, it's not far. But the point is that as soon as we moved the house, she adopted that office. So I've actually had to convert one of the bedrooms in the house to an office that I can use because there was no way I was ever going to use that office. Yeah.
Yep. Yeah. That happens many a day for me. Unfortunately, it's not connected to the wine room. Dang it.
Yeah, exactly.
We don't have one, but not a lot of time with that with 3 kids.
Well, I've got 4, so you need a wine room with 4 kids.
Yeah,
trust me.
That's probably true.
And when they become teenagers, that's the other problem.
You're glad it's connected to the office at that point.
Exactly.
Oh, that's too funny. But, so that's one of the big things. Now, another thing that we're seeing, especially with people working remotely, it's interesting, Lance, how, we've all talked about like, oh, it'd be awesome to be able to work remote. You'll go work from, the beach or the hill country or wherever. I have not been anywhere. I haven't had time, nor would, it's like, why would I pay to go somewhere to sit there and just do what I'm doing right here from home? But it's funny. So there are people who are actually moving states. I've talked to a lot of people who say, well, look, my kids are coming to visit for months at a time, or they're saying, you know what, we'll rent that beach house or lake house and just work from there. Now, the one thing we do have to be mindful of, if you're actually going out of state and going somewhere that has state income tax, you need to let your employer know, and you need to make sure that you're filing and holding those taxes back for each state that you work in. So this is something the IRS is going to come back, and potentially, if you were to be audited, they could say, well, where were you during this time? And if you work there for an extended period of time, you may owe state income taxes in another state. So you may be not
because you're in that state. You're not necessarily a resident of the state, but you're working in the state, collecting income, and the state's going to go, hey, you owe me state income tax.
Correct. So like if you let this go on for like another year, you and your employer could, have some consequences, because you need to let them know that essentially you need to be withholding for that state. So if you worked in, let's say, a state that has state income taxes,
California,
and you go to New York, which I don't know why anybody would do any of that, but get out and go somewhere with no state income tax. But you typically have to file your federal and both state income tax returns. So this poses issues that everybody thinks, wow, this is great. But if this is going on for an extended period, you may want to be thinking about these things. And think about all the people right now. So I've talked to a lot of clients say it's amazing. I've been retired. We take this trip every year. There's usually nobody ever around. And, like national parks, RVs. You go down the road, they say that the road's just full of campers and RVs. You can't get in some of these campgrounds because people found they can work remotely, and they're doing so traveling. Now, look, the burden of proof, I don't know how somebody's going to prove this with the IRS. I don't ever want to get into that type of gray area.
Yeah.
But something that should be considered if you are moving around and, you have that mobile office, so to speak, you can have a lot of tax returns.
You could, and and trust me, if you can work remote. You can go to places like Yellowstone, and work there. And if you get hungry, you can just boil a chicken in the Yellowstone geyser. And
yeah, what in the world? Why would you ever think of doing that?
I don't know, but the guy did it. He got kicked out.
Was that a bet, or was that like, I can cook this chicken here?
Well, I just needed to boil some water real quick, and there you go.
Oh man! So
it was kind of an experiment, I guess.
Well, did he chase the chicken down there, or was this?
Don't even go there. Know.
That's where you go, though, right? Like, wait a second, how bad was this really? Did he go buy this at the grocery store, or did he really scare everybody to death? Grab the chicken.
Too many jokes about chickens. Choking. There we go. Let's just let it go. All right. Anyway, but this is kind of an interesting point, though, because as we do go forward, this is going to pose some potential filing issues. Now, the good news about all this is IRS audit rates have now dropped to the lowest level on record. They've pretty much just given up doing. The IRS just says, "Send me your tax return. I'll send it back to you. We're all good." They've pretty much just given up auditing people at this point. I'm not sure why, but yeah, the audit rate is down to 2% now. It's just incredibly low.
You would think that would go up.
You've pretty much got to be egregiously
messing things up.
Yeah, messing stuff up on your tax return. Yeah, I made $6 million last year, and I took a $4 million loss. Yeah, that's probably going to get you audited, but
yeah.
Even with that, it's a very low potential audit rate. So,
what's interesting is that we this week, especially on Monday, you get the vaccine information from Pfizer. We, obviously the stay-at-home stocks got really beat up. Looks like there's going to be a swing back here at some point. Yep. But the CEO of IBM comes out and says, "Look, this hybrid model or work from home is going to be here to stay."
Yeah, it's not changing.
And because you got to think about it. I mean, if you own a business, you've got to improve your margins. You have to think that people are a little bit more efficient than I think what a lot of people expected. I do think that one thing that's missing is it's more difficult to entwine people into the culture of the firm, right? Mm-hmm. And I think we've even encountered that and seen that to some extent. But luckily, we had really good job with good people.
It's true, but I think you do lose something as well. And
camaraderie, maybe.
Well, but no, you actually lose brain power in a way, because when people are all separated, what you don't have is when people are in an office environment working, they're sharing ideas, they're collaborating, they're coming up, hey, I've got a problem with this, and a couple people get together and they work through the problem, and you have that collaboration, and you lose that, in this environment where everybody's so spread out, right? You lose that that ability, and true, the camaraderie and the birthday cake. Right. So
everybody should have lost a lot of weight over here.
Exactly. But you do lose that. And I think that ultimately, I think we're going to see that reflected in lower rates of productivity. And I think we'll also see companies moving more and more as they figure out what jobs can be automated. I think you're going to see a lot more of that move. And this is what I was talking about earlier in the opening segment of the show about the reduction in employment. Be right back after the break.
You're listening to The Real Investment Show.
With the last ballot tallied, what will America's legacy be? What does the future hold for your retirement, your family, for you beyond the election? Richard Rosso and Danny Ratliff's next Candid Coffee will specifically address your questions about money, retirement, risk management, and how to protect your household against financial vulnerability, regardless of who's in charge. Send your questions and join this post-election go-to webinar at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
A modern day warrior, mean try. Today's Tom Sawyer, mean ride. Those mine is not forever.
And welcome back to the show this morning. Taking your question and comments here, of course, is always at our website. Go by our website, realinvestmentadvice.com. Send us those emails. We love getting those emails, questions. We get stuff every day. We generally answer them within minutes by the time you send them, but you definitely get all answered by the end of the day. So, no matter when you send it in, you will get a response the same day. So always happy to help you out, whatever your questions are. So a couple of things, it's interesting. We're talking about the economy here. And as I was kind of opened up talking the show with a bit of the show is that, we had this big fall off when we shut down the economy in March. And now we're seeing this employment recovery, right? And, one of the things that, everybody's kind of excited about is like, oh my gosh, we're getting inflation, right? We're seeing inflation coming back. No, all we're getting is inflation moving back to the levels that we were pre-pandemic, which is what you would expect with an economic recovery from a shutdown, right? But that's going to stabilize at a level that is considered to be low rates of inflation, over a long term, right? So we're not going to go to 4 or 5% inflation. We're going to get back to, 1.5, maybe closer to 2% inflation. And that's it, right? Because that's going to align with the rate of economic growth, which is going to be somewhere between 1.5 and 1.75% as we come back. And that also really aligns much with what we're going to see in terms of employment. And again, when we look at these employment numbers and we get the unemployment rate. The unemployment rate 6%, in the last report. In the next couple of months, we're going to see that number continue to come down, probably. By 2021, we'll be back to probably, 4% unemployment. And we're going to go, great, we're back to full employment. This is awesome. But don't pay attention to that unemployment number because it doesn't really tell you the true story. What you've got to look at is the number of people in the economy versus those that are actually considered part of the labor force. So if you've got 300 million people in the economy and you've only employed, you've only got, say, 100 million people in the labor force, you can't tell me that 200 million people are sitting out and they're just decided not to work or they don't want to work or, they're just, retired or they're in school, whatever. This has been a problem. We've had these lower and lower rates. Ever since 2009, we've had a very low, what they call labor force participation rate. And the unemployment number, what we see reported, that unemployment rate, is a function of the labor force. So we keep shrinking and shrinking that labor force by not counting people as part of it. So once you've been out of the labor force for a period of time, you haven't searched for a job, whatever. And by the way, going on Monster or Indeed does not count as searching for a job according to the BLS, right? So after a while, you are basically extracted from the labor force. So as you see this going, just pay attention to, because what we're going to see now is a labor force participation rate that was lower than it was over the last decade. And this is going to be the new normal as we move into 2021. And so this is going to have a lot of impacts in terms of, employment and income and productivity. And there's going to be a lot of other ancillary impacts because of this, because the economy is changing to adapt to this new world that we were just talking about a few minutes ago.
So as we continue to see this adapt, where do people go? I think this is the biggest question that we get right now, because it's easy to chase, all the returns, the things that we see. I mean, it's funny because, not funny, but it's, many people coming into what just happened thought that we were going to see this major pullback, after the election, especially if it was contested, which here we are.
It's contested.
Yeah. and the market seems to just not care about any of this. We've seen rates go up. Rates, obviously, that's a function of.
And by the way, we're also supposed to crash without more stimulus.
Correct. And yeah, we haven't had that yet. But we're back on the table, right? There's some talks. No?
Haven't heard any talk lately about it.
I think Monday they said something about it. well, of course they haven't, because the market's going up.
Right.
But the moment, it seems like that's the barometer and the gauge. It's not necessarily the economy, it's the market. And so the market we have a really bad day. Oh, stimulus is coming out of the woodwork.
Right. Well, no, but the point here is that, to your point, is that there isn't stimulus in the works. I mean, we're not even talking about a stimulus bill at this point.
Yeah.
We've got a debt ceiling debate coming up on December the 11th. So they've got to fund the government post December the 11th. That may be a very interesting one, considering Trump being a lame duck president at this point, and the Biden incoming. So there's not going to be a lot of work, probably not a lot of, partisan work on, that debt ceiling limit. So that's going to delay stimulus even further. And at the same time, like you said, we don't have, and the Federal Reserve, they can't do anything else right now in terms of QE without more stimulus. So they're stuck. So, but the stock market, it's doing great. Right. I mean, you really have to start to come back and question, is like, hey, we keep driving our country deeper and deeper into debt to supposedly save the stock market, but the bond market is working fine. We have plenty of investment grade corporate credit hitting the market. We've got no problem issuing junk debt that gets immediately bought up. So the credit markets are working completely fine, which is the Fed's whole focus. Markets are up. So the question is exactly, what are we doing here, and what are the markets telling us, and do we really need to do another, put ourselves further and further into debts and deficits if everything else is fun? I mean, employment is picking up, economic growth is picking up, which you would expect coming out of a shutdown, right? We're getting, traffic's picking up. We talked about this the other day. People are going back to restaurants, regardless of the fact that we're racking up 1 million people a day.
So when does that matter again?
100,000 people a day in COVID cases. That hasn't seemed to affect anything at this point. So again, the things that were worrying the market before are not a problem for the markets now.
Well, I'm hearing, that they're even talking about shutting down school districts after Thanksgiving, just saying, you know what, we're going to stay shut down until after the holidays. Now, I don't know how true any of these rumors are, but because they believe that people getting together, obviously, families, that it's just going to increase the spread even that much more.
Yep.
So what does that do to the economy? I mean, look, this week has been great because of the vaccine, because of hope of reopening. Everything's going to be great. And what if all of a sudden it's not?
Well, the reality is that we're not going to get vaccine till a long time. All right. So Pfizer, and just to recap what we said yesterday, Pfizer made the announcement. It's great. It's 90% effective. It's still got to go through a lot. It's still a long way away from FDA approval. It may be approved for emergency use for people that are in dire straits, in hospitals. Basically, they're going to be test pigs as well. I mean, that's, they'll use it on them, and part of that will be their testing, but it'll be approved for emergency use. But you're not going to see this, and you're not going to be able to go to your local CVS and get a COVID vaccine anytime soon. That's going to be late 2021, maybe at the earliest, which means we've got a long ways to go before we get there. So yeah, this short-term hype in the market is not sustainable, particularly with the number of COVID cases rising. And if we do start to shut down the economy again, like they're doing in the UK and in Europe, that's a whole nother issue. I mean, the worst thing that we can do is lock down the economy again, in terms of markets and the economy itself, right? That would be something that would be very, very difficult to recover from.
Well, at that point, what do you see happen with small businesses? Because we know PPP, there's still funds left there. Main Street lending, I think last time I saw that, which has been a couple weeks or a month.
$600 billion total lending power, and they've used like $3 billion.
It's like 0.02% or something crazy. Yeah.
Businesses don't need it. Look, small businesses, A, don't want to go into debt if they don't have to, because they don't want to have to pay it back.
Correct.
But B, 50% of our small businesses are either going out of business or have gone out of business, and they're not going to borrow money to go out of business.
Yeah.
Right?
Yeah. Why get on the hook for something additional that you're just curtailing or prolonging what's the inevitable. Yeah. And so that's the problem. So, there's so many different things that we have to look at. And I think as investors that we want to take into account, right? And sometimes when we build portfolios, we have to look at, the actual full portfolio where we may hedge, we may do things that maybe if we look at, you say, well, why would we do that if that went down? But the reason sometimes is because, that went down because this went up. Mm-hmm. And there's a little bit of, it's part and parcel. You have to look at the big picture, not just each individual position. So for instance, like this week, fixed income has taken a pretty big hit.
Right.
So even days where markets have performed fairly well, and that's the interesting thing too, is that not all markets have done equal, right? We've had NASDAQ, which has underperformed the Dow. It's been a Dow week by all means. And now it looks like there may be that flip back where maybe value's not as...
Yeah, and by the way, if I was an investor right now, I'd buy a boatload of TLT.
Not a recommendation, and we do own that.
I'm just saying, if I was a guy that was investing, I would buy a boatload of TLT. It's 3 standard deviations oversold, and there's a record net short position on TLT right now. So, I mean, that thing is prime for a nice, pop, and a nice pop. In other words, rates coming back down, which would coincide with a weaker stock market. So.
Well, which we could see if we do get into the holiday season. You see the shutdowns. We continue to see cases rise. But, vaccines here, markets, that seems to be all that they're concerned with at the moment.
Right. Yeah. Well, look, I mean, you're going to probably have a sell-off in the first 2 weeks of December. And the reason is that every year mutual funds have to distribute their capital gains and their interest income for the year. So they have to do that. And so the problem is mutual funds are running basically record low levels of cash right now, which means they have to sell something in order to raise the cash to make their distributions. So this year in particular, we could see some market weakness in the first 2 weeks of December. Now, these distributions will start right after Thanksgiving, but a big bulk of them happen in the first 2 weeks of December. So if we do get a sell-off in the first couple of weeks of December, that would actually be a better buying opportunity to put money into stocks. Of course, bonds will have already performed well during that point, so you'd be selling a little bit of your bond exposure, buying some equity at that point for your end-of-the-year Santa Claus rally, which is the seasonally seasonally in strong bump, right, that we'll see.
And there are good things right now that you can purchase. There's been areas that have been oversold, so things that we're looking at here. But hey, go sign up for Candid Coffee. It's going to be this Saturday, the 14th. We're going to have a real candid conversation about taxes, what you should be concerned with moving forward, how we're planning for year-end moves, and all those fun things that Lance loves.
At the website, realinvestmentadvice.com. Have a great day. We'll see you tomorrow on the second best day of the week. See you then.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.